Good morning, everyone. I'm Elizabeth Poole, and this is Ed Zetlin. He's an elder law attorney, and he'll be talking about estate planning and retirement accounts. So with further ado, I'm going to let Ed take it over. Thanks, Ed.
Well, thank you, Elizabeth. Again, just to let some of you know, my name is Ed Zetlin, and I'm an attorney. I do elder law and estate planning, and I'm in Northern Virginia, Falls Church, Arlington. And if you need to get in touch with me, you can contact Elizabeth and she can give you my direct contact information. I don't know. And today I come here each month and I talk about some kind of estate planning issue. And today we are going to talk about retirement accounts and estate planning. So first of all, we need to have a kind of definition, at least in my mind, of what I mean by retirement accounts. By retirement accounts, I mean those accounts. I mean, you can call everything a retirement account. You can call your house a retirement plan. But here I'm really talking about those accounts that the federal government allows in which you could designated portions of your income to not be taxed and instead set aside into qualified retirement accounts, you know, the 401ks, the 403bs, the IRAs. Many of you are in the federal government. You have thrift savings accounts. Those are retirement accounts. They're retirement accounts because you don't pay taxes from your earnings from money that you put into your retirement account during that particular working year. So it comes off your income tax and it goes into these designated accounts, which are managed through your employee or through the federal government or through your own IRA, and they are, you don't pay taxes on them until you begin to withdraw the money. Then you pay taxes on them when you withdraw the money. And of course, the idea is these accounts grow over time. They're not taxed, so their growth in value increases faster because you're not paying your IRA, your 401k, you're not paying taxes when that goes up. Hopefully it goes up. Sometimes it goes down, but if it goes up and there's dividend income that coming in for whatever reason, or however you're investing your retirement accounts, there's not going to be any tax on it until you begin to make your withdrawals. For most of these accounts, if you make withdrawals before the age, I think now of 59 and a half, you would pay a penalty. There's been some exceptions, but the whole idea is they want you using this money for your retirement. That is to say, to replace working income when you're no longer working. And presumably, if you're no longer working, your income is going to go down, and your income is going to be based upon Social Security and these retirement accounts. So your income will be less, so your tax bracket may not change that whole lot when you begin to withdraw these money. Now, of course, if you withdraw it while you're working, of course, it's going to add to your general income, and you'll probably be having higher taxes. Now, for all of these accounts, there is an age in which you must begin withdrawals. You must begin withdrawals at a certain age. Now, those rules have changed over the last, well, let's see, since 2009, actually since 2021. it used to be years back that you had to make a withdrawals around 71 and a half, okay? That there had to begin withdrawals from these accounts. That was changed a year or so ago up to now, at least if you're born for a certain number of years, it has to be now 73. So my withdrawal won't be until I'm 73. And for people that were born in later years, the withdrawal will be in 75. I don't have those details in front of me, but I know for most of us, unless we're already withdrawing, for most of us, with the group that I'm talking to now, I would bet that the maximum age is 73. Now, for estate planning purposes, when attorneys talk about these retirement accounts and they're talking about estate planning, the whole idea is all about maximizing the stretch. That's where attorneys, I guess accountants too, that's where attorneys have all been concerned in doing estate planning, where we are in this essence, not everything, but for many things, to maximize the stretch. So what does the stretch mean? Well, at 70, when I'm 73, and let's suppose I want to take out the minimum requirement. Well, the IRS has a lifetime expectancy for me at the age of 73, okay? And under that lifetime expectancy, I have to take out, over those years, a certain amount so that it's used up over my lifetime expectancy, okay? Now, I may die before the lifetime expectancy, I may die after it, but in any event, the minimum is based upon these tables that the IRS has about lifetime expectancy. Now, of course, I can take out more. I can take out as much as I want, but you know, for attorneys, they're always concerned about. We're always thinking about, well, how do you maximize it? How do you reduce taxes? Well, the best way to do that is to take it out over the stretch period of your lifetime expectancy. So that's what attorneys mean. Now, so that's for you, the worker. But what about if you die? What are the rules that apply to beneficiaries of these retirement accounts? What rules in terms of the stretch apply to them? Well, when Congress passed the Secure Act in 2019, it designated certain beneficiaries, who still are able to take it out over their lifetime, okay? But they did radically change the rules. So in 2019, Congress passed a rule that says, okay, for those who want to stretch over their lifetime, there's only going to be certain classes of people that will be able to do that. So those people are your spouse. So if you die, your spouse can take your retirement account and fold it into their own retirement account and take it over their lifetime. Okay, they could take it out over their lifetime, the same as the person who died. So your spouse can do that. So and that's so the spouse is a category. Okay. The other categories for this are if you have a minor child. If you die and you have a child under 21, let's suppose you have a 400,000 in an IRA, and you have a child, you die, and you don't have a spouse, your child who's 16 inherits your IRA. That child can take it out over that child's lifetime, which, that would be a 16-year-old over what? The remaining up to about, in their 80s. So they could take it out over there. They get the stretch, okay? Other people that get the stretch is a beneficiary with special needs. So, for instance, I have clients, they have children who have special needs. They had special needs. They were born with special needs. Those children can also, no matter what age, let's suppose you died, I had a special needs child, I have 400,000 IRA. That special needs child, even if they are 40, they can take they can do the stretch over their lifetime, expected lifetime by that. It's not based upon their individual expected lifetime. It's based upon these average tables in which, if you're 40 years old, then the IRS says, well, actuarially you may live till 80 something. Okay, so that's your stretch period. There's another category for beneficiaries with chronic illnesses. I'm not going to get into that, but if you can prove that you're a beneficiary with a chronic illness, you may be able to get the stretch. Okay. Now, suppose I have a 26-year-old child. Okay. My wife is my beneficiary for my retirement accounts. She will get a stretch over her remaining lifetime. But my child, who's 26, if both of us die, she doesn't get the stretch. Now, the law used to be that your child would get a stretch over their lifetime. That was changed under the Secure Act. That my daughter now has to take it out over 10 years. So essentially, the federal government said, we want our money faster. So if I have 400,000 in an IRA account, then my daughter, let's suppose she's 30 and my wife is gone, and then I die, I have 400,000. She has to take everything out by the time she reaches 40. Now she could take it out. She could take out the whole thing at one time, but then she would have $400,000 income, and she'd pay an income tax based upon her income and the income from withdrawal of the entire IRA. Whereas if she had to draw it out over 10 years, then it would be reduced. She would be withdrawing what? 40,000. Each year she withdraws 40,000 until we reach, and so she would be in a lower tax bracket, and she'd be paying less taxes. So that's the whole idea of the stretch. Okay. Your spouse gets a lifetime stretch. A minor child gets a lifetime stretch. A special needs child, a person with a chronic illness. Actually, if you have a beneficiary who's only 10 years younger than you, that person gets a lifetime stretch, but that's kind of rare. But everyone else, for the most part, there's some exceptions, have to take it out over 10 years. And so that's what attorneys are concerned about. Now, now the other issues that became in the Secure Act is you could put more money aside if you're older you can, the limitations, that there was a whole catch-up rule that if you're over a certain age, you could put more money into a 401k and into a Roth and so forth. The whole idea was to get people to put more money away in the retirement accounts, because, you know, the government's worried about their people not having enough income to live off. So the way to do that, particularly in this world where we don't have pensions that used to, people used to have pensions. Now here in the federal government area, a lot of people have pensions and survivor pensions for their spouse, but that's not true of most of the country. Most of the country has gotten away from pensions, and instead people are socking away money in these retirement accounts with hopefully contributions coming from employers. That's going to be basically how we're going to deal with retirement on into the future as pensions become less and less. That's kind of in a nutshell how the Secure Act. Now, of course, you could leave money to not your children, you could leave to other individuals. That's fine. They're all subject to the 10-year rule. They're all subject to this. The federal government wants its money faster, and the faster they get the money, the more taxes that they can make from it. So that was the whole idea. It was actually an income tax raise, but nobody really said that. But it was, neither the Democrats nor the Republicans said that, but it was an increase in the income tax. Okay, so there is now. Then comes some of the estate planning issues with regard to do that. Well, first of all, you need to really make sure that you have designated beneficiaries for your retirement accounts. All right. You want to say to my spouse, and then to my then to my two children, 50% to this child, 50% to that child. You probably also want to say 50% to this child per stirpes. This is in the retirement plan itself, and that means it goes to that if your child dies, then that child's children would inherit it. Now, you actually have to check with each particular holder of the account to see what language they want to make sure that works. Every account is a little bit different. You could say, I leave my retirement account to my spouse and then to my children. Will that work? Well, that will work. It would have been better if you said proportionally to each child, how much each child should get. And by the way, you could say, 80% to this child and 20% to this child. You can do that. I think it's better to use percentages just so that there is clarity. You want a lot of clarity with regard to these accounts. Some of you, I don't know how many of you have younger children. You will find now with a great number of investment companies like Merrill Lynch and Edward Jones and all of them, they have what's called trusted IRAs. That is, you can set up the retirement account through the financial institution to have it go through a trust. For instance, if you're concerned about about your $400,000 going to a 16-year-old suddenly, you can arrange it. For instance, Merrill Lynch has trusted accounts in which the account can go. It's not under the control of the child or even it's controlled under the terms that you've made. And you can say, well, I don't want my child, not only do I want it to go, I want the money to get paid out, but I want it to be held in trust, whatever is paid out, until this child reaches a certain age. So that can be done also. And of course, we attorneys, we do trusts, right? And so the whole issue becomes, I now do a trust. My wife and I now do just a simple living trust. How do I work out my beneficiary designations for my retirement account? Okay. So my retirement account says I leave everything to my wife. Then it says I leave everything to my child, who's now an adult. But I might want to say after that, I'm going to leave it to the trustee of my trust. Okay. So suppose my daughter has children. Okay. And my trust, of course, is going to say I leave everything to my wife and I leave everything to my child. But my child, if my child dies, it goes to her children in equal shares. So her children may be minors. Well, I don't want her children to suddenly get lots and lots of money. I want it to be under a trust. So I can do that in a trust that I set up. Okay. I can say, in fact, I could say everything goes to my spouse, but then everything goes into a trust. And the trust has what's called conduit language, which says the money each year goes in, but then it goes out to the beneficiary. So I can do that. I also, let's suppose I had a special needs child. I had a child who has autism. Well, of course, the whole issue there is, even though that child gets a lifetime stretch, if I were to leave that IRA account to that special needs child, and that child is getting SSI and Medicaid, if they were suddenly to get all of that income each year, well, what happened? They would lose all their benefits. So I don't want that. So I will set up a special needs trust, and I might say 50% of my retirement goes to the trustee of the Elizabeth Zetlin Trust. And that trust, again, that trust will then receive my retirement account. But instead of my money going directly to that child who is on SSI and Medicaid, it will hold the money. It'll pay the taxes based upon that child's income, which may be very little. Okay, so it'll hold the money. It'll pay the taxes will be based upon whatever that child's income bracket is, special needs child income bracket. It may or may not have any taxes to pay. And then, of course, the money won't go to the child. The money will be spent on third parties to better the life of my special needs child. And that could be also true of a minor child, where the trustee is making decisions about where the money is spent. They're not going to give $25,000 to the child, but they might be spending other money for this child for food, clothing, and shelter by paying to third parties for that individual. So you can still use trusts. In fact, for disabled children, you must use a special needs trust and have the retirement account flow into the trust. Now, there are still some rules about retirement accounts where there's still some rules about if the retirement account in some way leaves it contingently after everybody dies to a charity, okay? That is kind of a no-no with respect to trying to get stretches for individuals. So you still have to be a little bit careful because the IRS wants the money. They have terms in them which they say they want the money to go to an identifiable human being. And if it's not identifiable human being, when the money is paid out, then you may not get any stretch at all, or it may be subject to a shorter term, a 5-year rule. So you have to be careful, even though the money is not going to go to a charity, it's going to go to my children. If I've left it somewhere in the trust with the possibility of going into a charity, then I might have a problem. So you have to be careful when you are in any way having a trust and leaving it to a trust. You want to be sure that there is no charitable giving. Now, that doesn't mean, for instance, I have a client, she had no children, and we're leaving all of her assets, including her retirement accounts, to a charity. That's fine. You can do that. The charity itself is the direct beneficiary of all of her accounts. Actually, everything goes into a trust and then it goes, but all that means is there's not going to be any tax because everything is going directly to a charity. So charities don't pay taxes, so it goes to the charity. They're a nonprofit, it goes to them tax-free. You can still do that. You can still do that if you know, if you're not having it going to any particular person. Or you could one example is I had a man who was in the military last year, and he suddenly got he was in Iraq, and he suddenly developed cancer, probably due to his service, actually brain cancer, and he had 3 minor children. So, and a lot of his assets were going to be in retirement accounts that he had accumulated. And he had a house. So what we did was we set up 3 different trusts for each of his children. All of these retirement accounts are split between these 3 different children. If one child predeceases him, it goes to the other child's trust. And so if he were to die while they're minor children, all of their income would be, they would get the stretch, but and they would get it over their lifetime, but it would be in a trust until they're about 30 years old. So they wouldn't be making decisions about how much they wanted to withdraw, and what they spent it on will be in the hands of a trustee. And so we wanted to do some planning to make sure that his minor children were protected and not subject to creditors. And he had some concerns if they're too young, if they're in their 20s, and they suddenly have access to all of this money, they might do something foolish. And he wants to make sure that they are, you know, quite mature until they have full power over these retirement accounts. But what we did was we created separate trusts for all of these children. We put the house actually into another trust. House is not subject to the other rules. And, you know, if all the children died, then, you know, beforehand, then that house could go to a charity or could go to some entity. So that would work. But you just have to be mindful as an estate planning attorney. I have to be mindful of some of these peculiar rules and complicated rules that apply to retirement accounts and estate planning. So let me see what time it is right now. It's 11:30. I've talked a lot. Do we have any questions for right now? Does anybody have any questions?
Okay, one just popped up.
Okay, so if an IRA goes to a trust whose beneficiary is my child, is the stretch over 10 years or shorter than 10 years because it is in a trust? It should be under the 10-year rule. Okay. Should be under the 10-year rule. Unless there are minor children. Okay. It should be under the 10-year rule without any problem. The question, I guess, is it now you want to leave it. Let's suppose you left it to your child. If you say the child has to be readily identifiable from the trust. Okay, so what you might have is I leave my trust. I have a trust, and I leave everything in trust to my child. Okay, or I leave everything to the trustee of the Elizabeth Trust. That will work. That will be subject to the 10-year. That'll be subject to the 10-year stretch.
So, Ed, I'm the one that asked the question. This is Rosamunda. I thought I read that the stretch in the trust was just 5 years. Is that not correct then?
10 years.
It's 10 years. Okay, thank
10
you.
years. It could be 5. Let's suppose somewhere in the trust it has a charity. It says, if all my children die, then I leave everything to a charity. I believe that could be subject to the 5-year rule. So you have to be careful about that.
Okay. Thank you.
Or if you leave it to my trust and it says to any of my beneficiaries of my trust, and it's not clear who the beneficiaries are, then it might be subject to the 5-year rule.
Yeah, basically, you have to be clear it's to your child.
Yes.
Thank you.
I understand that the TSP taxes the level 20% level if the beneficiary is a trust. That is a high level. Is there any way to get around the high tax rate? Well, that's the TS well. Okay, so if you leave it to a trust, let's suppose you leave your to a trust, okay? And in my trust, you have designated beneficiaries, okay? I have 3 children. I have $500,000. I'm leaving everything to my trust, and my trust says, if I don't have a spouse, I leave everything to my 3 children. Okay. Those 3, what happens is the money goes into the trust over the 10-year period, but then it gets paid right back out to the children. It goes into the trust and then it goes out of the trust. In which case, it's just subject to their income tax rate. It's subject to their income tax, not 20%. That, unless depending upon what their income is, So that's called a conduit trust. The money goes in, the money goes out. Okay. Of course, the trust does have to be, in order for the trust to qualify, it has to, for designated beneficiaries, it does have to become irrevocable. Now, if money stays in the trust, it's an irrevocable trust. If money stays in the trust, then it's subject to a special tax on a trust. okay? So irrevocable trusts are taxed at a higher rate of income that the trust earns in and of itself, okay? But the money is going in and then going out, then it is it's not gonna do anything. The reason why you might say I leave it to my trust is because the trustee is going to say, look, I want this 30-year-old child to simply get money over the 10-year stretch. I don't want this child to suddenly say, I want all the money at once. So the trustee has control over how much money comes out of the trust, the minimum amount, it goes to the child, and then next year the same thing happens. In other words, the reason you wanted to leave it to the trust is you're concerned your child is going to take all of the IRA all at once, and you don't think that's a good idea. Okay, that's where the trust can be useful. Okay.
This is Amy. I asked the question. I don't have any of those complexities, but basically my understanding from reading the TSP documentation on this is they just pay the whole value of your TSP account to the successor trustee. They don't get involved in doling out the money to your beneficiaries in your trust over 10 years.
You mean for your thrift savings plan?
Yeah.
They say that they're going to pay the trust all at once.
Yep. And then if you've got the beneficiaries mix between individuals and charitable organizations, it just seems like they're going to tax you once and then the people are going to get taxed again when the trust distributes the money to all the beneficiaries.
There's only one tax.
Yeah.
If the TSP is going to hold back money,
No, they don't. They want to just pay it all. They pay it all out. They don't get involved in distributing it to your.
so when you distribute out to the beneficiaries, okay, it'll be subject to what their income tax is. What they
Right.
pay. So if you get $100,000 this year from an IRA, okay, let's suppose you have $1 million and you get 100,000, okay, then that 100,000 is going to be taxed to that person. Okay.
No, I think again, the problem is they just pay it out and the trust, the executor of the trust manages all the payouts from there.
That's
TSP doesn't get involved in that.
Okay.
But somebody.
So the trustee still has to make sure that that person gets at least the minimum distribution.
Right, but it's all about if the TSP is already taken, but somebody here says she thinks you can adjust the 20% tax rate that TSP, but maybe I have to call them because this.
Well, they're just, unless they're doing a, I mean, the TSP does withholding.
Yeah, they're taxing at 20% for a trust.
They're doing withholding. So, for instance, I have a woman that left everything to a trust. So I just got her TSP. I'm getting a check for 200,000. They're doing withholding for taxes. Okay.
Right.
When I file, she's a decedent. When I file a tax return, I will get the remaining 20,000. That remaining 20,000, because she's going to leave everything to a charity, is just going to be paid to me.
Mm.
And that's when I will get that money. They're just, all they do is withhold money.
And so when whoever files the taxes for your.
Yes, whoever files the taxes has to pay,
The
that's
20%.
what determines it, yes.
Okay.
They
Okay,
all they do is withhold,
okay,
because they're not, all they're gonna do is withhold. That's how the TSP works. And then, so it's not a tax, they're just subject to withholding.
okay, that's helpful.
And then you, later on, you'll file returns and get the money, and then the beneficiaries, if they're individuals, they'll have to pay the tax. Does that
Okay,
make sense?
yeah, that makes sense, but they
Okay.
certainly don't describe it like that.
Right. Yeah,
Okay.
yeah, I think the
There's-
TSP is not taxing, but it's withholding. That's right. They're withholding
Yeah.
20%.
So
Yes.
Ed, there's a question that's above that. What if you don't have children, but leave to relatives like nieces and nephews? Same rule apply?
Rules apply. 10-year rule.
Anyone
Yep.
else with questions?
Yes, I have a question. I came late, my question has to do with IRAs. I am the beneficiary of an IRA, and I assume that the 10-year rule doesn't apply to me because I've been taking distributions from this IRA for about 19 years now.
Well, this rule came into effect in 2019.
Okay, and it's not retroactive, I
No,
assume.
no.
Okay, that's good. Thank
It
you.
only said after 2019, these are the new rules.
Okay.
So you don't have to worry.
Rosamunda? Did you
I
have?
have a quick question. Are we talking these rules and your suggestions on the stretch for IRAs and 401ks and
Yes, they're all subject, yes.
Oh, okay.
All
thank you.
retirement accounts.
Okay, thank you.
403Bs. Basically, the rule is, the rule says that when you die, all of these become, in essence, IRAs.
Even 403Bs?
Yeah, they all say they become IRAs, and they're subject, and then there's a statute about how they act as IRAs. And so they're all subject to the same rules.
Okay, thank you.
Yeah, but I mean, if they had different rules think of that, if they had different rules for a 401k as opposed to a 403b, as opposed to an IRA, that would be a mess, right? That would be
Yeah.
a real mess. So at least they got that right, but 401ks applies to employees, 403bs, charities, and so forth. And there are different rules that apply to the employers slightly.
Yeah.
But in terms of how they affect you, that's the same. Better be anyway.
Another question?
Yes, this is Steve Maloney. I had a question for you.
Yes. Sir.
You had said if you leave money in the trust, it gets taxed at a different rate. What rate is that?
It's a compressed rate, and I'm not, in other words, it's a compressed rate depending upon, in other words, it's an income tax on the trust based upon how much income it earns. So, for instance, after, I believe it's after $600 of income in a trust, irrevocable trust, okay? Income that the trust earns is subject at that point to an income tax. What the rate is, I don't know what the rate is. In other words, it's compressed. It starts to earn taxable income at a much less amount of income distribution. Does that make sense? Now, if it doesn't earn any income, let's suppose it earns income and it distributes out all the income from the trust. There's no income tax on the trust. because it made distributions. So let's suppose you have an irrevocable trust. People do this. An income only, so income that the irrevocable trust makes is under the trust rule, all distributed. Trust is not going to pay any income tax. If income stays in the trust, then it's going to pay income tax at a higher rate in terms of when in other words, there's no 20,000 deduction or 24 deduction, or you don't pay income if your income is, no. A trust is not a human being, it's not a person. And so if the money stays in the income earned by the trust, it pays a compressed tax rate. But I don't know what I can't give you the number right now. Does that make sense? Probably not.
I understand.
Right. But if you pay out all the income, then there's going to be no taxes. That's how it works.
So Ed, one more question. Do investment accounts ever have to go through probate if not going through a trust?
So let's suppose you have, here's your asset. You have house, you have retirement accounts, and you have some brokerage accounts. Besides putting money in your retirement accounts, you squirreled away other money, you maxed out all your retirement accounts, and you still had extra money and you invested that. And it's in a brokerage account. Or maybe you inherited some money and it's in a brokerage account. Brokerage account means it's not tax deferred. Okay? Now, of course, income that your brokerage account earns, some of you have that, you have to pay taxes on that. It's part of your income tax. Okay? If you die, let's suppose for all of your retirement, you have designated beneficiaries. But there is no designated beneficiary for the brokerage account. If there isn't, then that will have to be probated. That will have to be probated, say under your will. Now you could say for that brokerage account, I leave everything to this particular individual, or you could say I leave that brokerage account to my trust. In which case, the brokerage account is going to be payable to your trust. There's no probate for that because you've designated the trust to get the money directly. So it doesn't have to be probated. It goes into the trust, and then your trust determines how that asset is distributed.
Yes, so
Okay.
I asked this question. So no, it's just basically I have a trust and I have an IRA account that's not in the trust.
Right.
Because if you put it in the trust, then the successor trustee, if it's a company, will charge at 3% of the value of the trust. So if you have a ton of money in an investment account, it seems like you should just keep it there and distribute it directly and not put it first in the trust. But the question was, if it's an investment account and you have beneficiaries, it doesn't have to go through probate, right?
If it's an investment account and you have designated beneficiaries, it does not go through probate. Correct.
And if it's an IRA, same thing.
The reason we don't put the IRA in the trust,
Right,
why is that?
because they're going to charge you.
No, you can't put an IRA in a trust.
You can leave it to a
You
trust
can leave, that's a different
as a
that's
beneficiary.
legal thing. You could leave it to a trust for particular reasons, but you can't put the IRA. The only way you could do that is pull out the IRA pay the taxes, and then put the remaining in the trust. Sometimes that's done, but generally that's not done. But that's different. So the IRA is not, it's left to a trust, but it itself doesn't get retitled into the trust while you're living.
Well, I have one that is.
You
It's
do?
in the name of my trust, yeah.
It's in
but
the
my
name of your
question-
trust.
Yeah, but my question is much more, if you have an IRA and you
You
have,
have an IRA and you've designated beneficiaries, it
you
goes to the
don't have to
beneficiary.
go through probate. So you don't have to put it in the trust. You could just have it
Most
distributed.
people don't. My IRA is left to my daughter.
Okay,
It's not in my trust.
okay,
My house is in my trust. My other bank accounts are in my trust,
okay,
but my IRA just goes to my daughter.
okay, great. Thank you.
It's always best when you use yourself as an illustration.
So probate's only really for property or anything not dumped into the trust.
It's for property. So it's for property that doesn't have designated beneficiaries
Okay,
or left to your, for instance, I have been a trustee and parent for a woman who recently died. Okay? I was never able, she was never had the capacity to tell the TSP people that I want to leave everything to my trust. I couldn't get through to the TSP people. Don't ask me why. They're impossible. So what does that mean? That meant that when she died, she's got about 200,000 in a TSP.
yeah,
Her will says I leave everything to my trust. But the TSP is suddenly not going to write a check to the trust. So what do I have to do? I had to open up an estate.
Hmm.
Okay, I had to open up a probate estate. Not a big deal, you know. There's no children. Everything's going to charities. Open up an estate. The will says I do that. Now the TSP is going to write me a check.
mhm,
Write me a check for 200,000. They're going to withhold 20%. Goes into an estate account, which I have to go through probate. I have to report $200,000 going to an estate. I have to report it to the court under the probate rules, how much comes in, do an accounting, all that kind of stuff. I mean, it's more work for me. And then I say, who gets the money in the end? Well, then I have to pay it to the trust. And then the trust says, pay it to these charities. So it makes the process more steps.
Yeah.
Because I couldn't get the TSP to designate the trust as a beneficiary.
right,
Because they were,
impossible.
they wouldn't answer their phone. They were just very difficult. Sorry. They just, if you talk to financial people, they'll tell you, take your money out of when you retire, take your money out of the TSP and, have it go to a financial institution for that purpose. So anyway, that's what happened there.
I have a question. I have a irrevocable trust from my late husband. I have a living trust, which is which basically owns all my property and my brokerage accounts. But I have like checking accounts, cash accounts, which I hold jointly with my current husband because I remarried. I make him the beneficiary on those. Would
Right.
that be any sort of an estate problem in the end with my living trust?
Well, suppose he dies before you,
Yeah.
and then you die. So what happens to those
Okay.
accounts?
You're saying that there's a problem if we both die at once, then,
No,
or shortly.
You die.
Mm-hmm.
Now that account, that checking account, savings account, okay, is going to be governed by your pour over will and then your trust. I say pour over will. Probably your will says, when I die, everything that I have goes to, if I haven't put it in my trust already, now goes into my trust. That's probably what it says.
Mm-hmm.
May not, but it probably says that. Now you've died. Now your husband, he died before you, then you die. Now you have 70,000 in this account. How do we get it into the trust? Doesn't go there automatically. You could have designated, well, I think you could have designated it when I die, you could have had POD on that account to my trust. Pay on death to my, what is your name? Give me your first name.
Nancy.
POD to the Nancy Trust, the Nancy Living Trust. That might work. Then you don't have to probate that 70,000. You don't have to go to court and open an estate account. But if you don't do that, or you could say, I'm going to leave that 70,000 to my niece or nephew. But if you don't do that, it doesn't get into the trust automatically unless you go through the probate process. Does that make sense? What I'm telling you?
Okay, so I should,
You have to think
I
about
should
what
have, I
happens.
should have a beneficiary that is my trust
You might,
as,
if you, it should say, if my husband dies before me, then this money goes into the Nancy Trust.
okay,
See if
Okay.
if you can arrange that.
okay, thank you.
Just
And
because,
there was,
I mean, it's
there was
not a
another-
terrible thing to open up a probate estate, but if you can avoid it, you might want to do that.
there was one question I don't know that got answered. Don't you designate your trust as the beneficiary of your brokerage account by making the living trust the owner of the brokerage account?
You make it a beneficiary of the brokerage account. Oh,
Hmm.
you can put your brokerage account into the trust. Yes, you can. In fact, you should do that. If you have a living trust, you should put your brokerage account into the trust. Good idea. So you take that brokerage account, which is owned by you as an individual. This is a non-retirement account. And now you transfer the ownership into, under the trustee, under your living trust. That's a good idea. In fact, if you're going to do a living trust, you should do that with your non-retirement accounts.
Okay, anybody else have questions? I think we wrapped up all the chat questions.
I
We're
had-
just,
I have
okay,
with Amy. Ed, I had heard for when people administer your trust, if a financial or a lawyer is the successor trustee, they charge, the standard rate is 3% of the value of the trust to administer it. Is that, you're saying no, that's not
Well, it
true?
depends upon what you agreed to.
Okay. So is it better to
What you
do a
agreed to.
percent of the value or to have an hourly rate or?
You could say an hourly rate. Most attorneys under it says reasonable oftentimes, and reasonable generally means what the Office of the Commissioner of Accounts thinks is reasonable. And it's usually about 1%.
1%. Okay, very helpful. Thank you.
Depending on how much money it is, but 1%, say. Or if it's, might say 1% for the first million and then whatever, it might, it depends upon, I mean, it's a little bit more complicated than that, but.
And it's the office of the who?
We have an office of we don't have a probate court in Virginia. We have a Commissioner of Accounts.
Okay, Commissioner of Accounts. Okay.
How we doing? It's 12 o'clock.
yeah,
Does that
pretty
mean?
good with lots of questions. I have one question, Ed.
Yes,
An executor, is that a set percentage that they get from?
yes. Generally, if it says reasonable, it's under yes, it's under what the Commissioner of Accounts has said that executors or administrators get. Yes,
So every account, every estate would get a different,
depending on how much is going through the estate, that is correct. It's the
okay,
same rate, but it depends upon how much the estate is.
okay, thank you.
Okay? All right, well, this was fun. I had a good
Yes.
time.
Yes.
Hope you had a good
So-
time.
We have 2 more of these sessions coming up, June 7th about wills and June 12th about trusts. So put it on your calendar and we look forward to seeing Ed and the rest of you. Thank you so much, Ed, for your
Thank you.
time.
Okay, thank you all.
Bye,
Have a good
everybody.
day.
Have a
Enjoy
great
the
day.
sun out there.
Great.
Thank you.